Basically, we are telling them that the world actually is still growing. If you look at China, China is starting its recovery of the past few months, and we think that will continue. In the US, we also see a continuation of a steady growth of somewhere around 1.5 to 2.5% per annum. And in the case of Europe and Japan, although growth is a little bit slower, but still it is positive rather than negative. So I think that, and in the case of Brazil, for instance, the noise happening there seems to be quite positive in terms of the political developments there. So when we put all that together, we're still looking at the world which is still growing. And also in the investment world, as we all know, interest rates are extremely low. So that actually should be quite positive for those who are looking to extend beyond cash and bonds and look into equity markets or corporate bonds markets.
Let's talk about that. Is there an investment case for Japanese equities when you can argue that the wheels are coming off Abenomics, the wheels are coming off Coronanomics as well, and negative rates are having a very counterproductive impact, especially on the banking sector?
Yes, well, as far as the Japanese market is concerned, as far as our portfolios are concerned, we have been reducing that over the past few months. But we're not out of the Japanese market altogether, no, because within the Japanese market, there's still a lot of companies which make a lot of sense to us in terms of their growth profile and in terms of their valuation. But the overall market, I agree, it has been quite disappointing. And the same goes for Europe, really. The European market also has been disappointing as well. But I think that it is more a matter of those two markets actually being the winners last year. And this year, there's a reversion to mean. So that means that emerging markets and the US actually are outperforming the winners of last year. So I think it's rotational rather than death.
Okay, let's talk about China. If you want exposure to mainland equities, is it still dicey, Kim Do, because of the economic uncertainty, policy uncertainty, bad debt issues, etc.? And does Hong Kong still remain the relative value trade, if you want some kind of proxy?
Yes, I think you're right on that. Although I must say that in the Asia market, if you go down to the mid-cap levels, you can still actually see and invest in a number of interesting growth opportunities in the mid-caps area. But if you look at, if you talk about the large caps, then definitely I think that Hong Kong is a better place to access the Chinese exposure.